you mentioned self-managed super fund. Mitch, who's a regular pest in the group, actually said, when is the right time or dollar value for partners to create a self-managed super fund? Two people, one has 600K, the other has 350, paying fees in both accounts, and could consolidate into a single fee within the self-managed super fund and maybe keep one or both open depending on the insurances provided. Just on the insurances provided, if you're setting up a self-managed super fund and you've got a super trustee policy, you can redirect the rollover each year to that policy, or you can actually rewrite the policy with your advisor and have the super fund own it. It's only if you've got default cover in your fund that you might need to keep some money. Do you guys have any rules of thumb in your business? If someone knocks or bashes on the door, I want a self-managed super fund. I've seen some ad on Facebook. They said I can buy a property. Give me a self-managed super fund, or super's a scam. I want to control it myself. What's a bit of a house view, vibe view for each of your businesses?
I called Deline and I vent to her for about 15 minutes about no jokes, but no jokes.
You're not far off.
Yeah, not far off. No, go, dude.
Yeah, look, I think the rule, like the house rule, is that you've got to have closer to $1 million. So those clients.
Your house rule?
Yeah. So I think the ATO says like $500,000, or it might even be $250,000 if
but
there's going to be.
That's a guidance, not a rule.
Yeah, absolutely. Yeah. I think they say that that's when you can like start considering it to be of benefit. But I actually find the break-even point needs to be a lot higher. So I think it needs to be closer to $1 million. But the reality is, what's the strategy and structure first? Fees is one thing, but a lot of people will actually have cheaper fees staying with an industry or a retail fund rather than setting up an SMSF, even though it's percentage based versus the flat fees. And also, the SMSF.
And a lot of super funds have also got admin fee caps. So they're very conscious of this. Like, you got to think about it. They know that self-managed super funds have been a massive rise in Australia, and they're running a business. So they're going to remain competitive, and they're pricing these accounts to be competitive, especially at the higher fund balances where they know that this money is going to be leaked out. So I think I'm similar to you guys at Mazzy, like a thriving wealth, like anything that's probably less than $1 million. You really need to justify the reasons why. And there sometimes is reasons why. It might be, for example, like a company wants to buy a factory. They want to kind of utilize that. They might... I have a really good story about a client in their 50s. They had a property in there. Property was doing really well. There was no reason to get into it. But what we really worked is on the strategy to prepare them for retirement, to have liquidity, have other funds, have true diversification. And if done well, a self-managed super fund can be very, very, very beneficial. Unfortunately, it is, Glenn, those people that are coming in saying, hey, listen, I want to buy 100% of crypto. We have so many people that are coming in. They might hold crypto, gold, silver, cash. That's all they've got. Why do you want it? Well, I don't trust anyone else. But really, when you can't start to unpack self-managed super funds, you unpack the responsibilities of a self-managed super fund trustee, and we start to educate people around them and show them the alternative ways to get to the destination that they want to get to. In more cases than not, once we've educated, they're like, okay, I don't want all the responsibility. I don't want all the work. So we like them. Do we recommend them often? Probably not. Our average age is about 40 years old for a client. So for 40-year-olds, we find that there's a lot of different ways to do it, unless they're ultra high net worth, business owners, or we have complex structures that we need to work on in families as well.
Yeah, I was going to say, I worked for a firm that specialised in SMSF. So probably like 95% of my clients did have SMSF. So I was there for 5 years. And so I love self-managed super funds, but they were high net worth clients. So they did need a bit more like complexity, or like their strategies were a bit more complex. But I would say for the average people I'm working with today, we're shutting down more than we set up.
Yeah.
And Jade's got a really good story, actually. We've got a client that's come to us recently with an SMSF.
Story time. What is it, Jade?
I think like a lot of people that set out with a SMSF, it is for that control, and they want to, select the investments that they're in. So a recent client sort of came to us and they had about 1.5 in their super, and about 1.2 of that was sitting in cash, and had been for a number of years. So the opportunity cost of that was quite great. And their, I guess, main rationale behind that was, well, I don't want to pay managed fund or ETF fees. they picked 3 direct shares and none of it did too great. So there is obviously that, if you're doing it on your own, are you getting advice or do you feel confident in those investment choices?
So let me get this straight. They set up their self-managed super fund with 1.5 mil. They got 1.2 million in cash and a couple of direct stocks. Is that what we're talking?
Yeah.
And what they were just didn't want to move from that position. Like they trusted maybe those 2 or 3 companies and the bank they were with. Like, yeah, like isn't the opportunity were they aware of the opportunity cost or did you have to educate them on that?
Definitely, they came to me and said, we feel we may be being too conservative. And he gave me a list of ETFs that he would consider. 50 and 55 is his spouse.
Yeah, okay.
And so they were aware at this point, but I don't know whether it was hindsight awareness that, whether they've had a conversation.
Or whether they probably lost 200 grand over the last 5 years.
Yeah, so it's it was interesting, but it was good. We've come a long way from our initial conversation. He was very much, I really want to keep cash, and they're actually very high income earners, so they were saving a significant amount of money in a cash account every month because they want to retire in 5 years, and they were going to draw down on that cash. And when I ran the modelling and I showed them, look, if we only invest half of this money of your whole portfolio, because we're talking a lot of money here, you'll have like $3 million at the age 80 versus running out of money. So it was very eye-opening, I think, for them just to consider some basic maths.
Yeah. I just loosely crunched some numbers, and I don't love the fee tagging, dog tail wagging the investment dog or whatever that is with fees. But sure, if you did have 950K in a fund that was 1% a year, right? It's 9,500 a year in fees. If you did a super fund that we'll say, because you still have to pay an investment fee, even if there was an investment fee of 0.35, might be more, might be less, because you probably would want some type of wrap account or a brokerage account or something like that.
The reality is it's hard to buy international equities directly, so you'd probably want to have some managed
some type of platform or something.
ETFs, yep.
And then if you did maybe $2,500 a year in audit and accounting fees, that's $5,800 a year. Sure, you might be ahead $3,500 a year.
I'd say 1% is pretty high to be using in the first comparison, though. Like, I don't think many of my clients would be paying 1% in their fees.
Most of them have like a admin fee cap of like $2,500 these days.
Yeah, okay.
And then they'll have like
should I use 0.8?
And then, I was going to say, and then they've got investment fee of, say, let's say on average, if you use a normal balanced account, say 0.7.
Okay.
So 0.7 on the actual investment, and then a $2,500 flat cap.
Yeah, okay.
Okay.
Yeah, so even if I just did 0.75.
Yeah,
like there's still, based on my scenario, of around $2,500 a year in accounting fees and having a 0.3% fee on the investing. It's only $1,300 a head. Now, you'd be like, oh, we'll stake do it for $600 a year.
E-super.
Yeah, that's
$1,000
cute, but I'm probably just going to my accountant and I don't know. I'm just skeptical of these companies that are coming in just full on promoting self-managed super fund management.
Yeah.
Because it's an easy pot of money to get from people.
And the thing is with your off-the-hand calculation, like, we will wind those fees right back.
Yeah.
Like we'll bring those right back until they're like cheap as chips, because fees compounded over a long period of time have an effect on a person's balance, and we get that. So we need to be very fee conscious. We also need to understand the purpose that people are having behind all of these investments as well. And because we see clients average age about 40, so anywhere between say 35 to 55. These people still have a long time horizon. So we want to get usually into direct equities. We want to get into that. It's only until we want to get into property that we literally look at self-managed super funds. So index-based investing, which we are a fan of, those investments that I did at 0.7, we'll probably get those down to peanuts. What's VAS these days? What's.
But you'd still have to pay a platform fee.
But that's capped.
Yes.
That's what I'm getting at. So that's capped. So say you got the 2.5 cap and you can get, say, the MER or whatever down to like 0.1, 0.2.
Yeah.
That's crazy.
Yeah. And that's it. I think there's less of a compelling reason for a self-managed super fund if it's just fees that you want. Now, sure, if you want to buy 100% Bitcoin with your fund, that's cute, but you're going to have a director's responsibility to make sure you've got a diversified fund with liquidity for the retirement benefit of the member, which is also you. So you've really got to make sure your investment strategy is legit. You live by the sword, you die by the sword.
Yeah.
And I just don't think there is always the case for self-managed super fund.
Yeah.
Now, if what's the type of house view with your businesses? If I walked off the street and I'm like, oh, I've just got this old super fund, and relatively to the pack, it was high fees and it didn't have actually a decent track record. What are you guys doing with recommendations for funds? Do you have go-to super funds? Or do you just put everyone in a wrap account and charge them ongoing fees? And
No, definitely not. Like,
all that bad
we've got
stuff.
a mixture. We've got lots of clients that have industry funds, and we'll sometimes recommend moving to an industry fund. And then we've got a bunch of clients that do have retail wrap accounts. So it really just depends on what the features are that the client needs, how hands-on they want to be or hands-off. Do they want ethical investments, like all that kind of stuff. But one of our major funds that we had talked about offline is Australian Retirement Trust.
Yeah.
And so that's not a product recommendation. It's just general chit chat here.
they're actually, in 2 days' time, there's an episode on the show with Jodie Fitzgerald. I was at their office last week. So yeah, they've supported the podcast off and on for a few years.
I worked for Sun Super
Yeah.
a million years ago, where I started my advice career, and so I did a stint in insurance claims there. So I'm pretty comfortable with the fund. But the reason we use them a lot is because they are really easy to use. They've got index investments, and they've got a mixture of single asset classes as well as the pre-mixed index options.
So if you wanted to build a portfolio, you could use a product like that for your clients. How does that work?
Yeah, I think for a majority of our clients, we'll be able to use an ART, an Australian Retirement Trust, because of some of the reasons that Deline said. I think one of the other ones as well too is the auto rebalancing. Okay, being able to kind of auto rebalance so that you're constantly not working with drifting. I think the other one as well too is that it depends. I would also say for most of our clients, it depends on the purpose they're behind. So, for example, let's say I had that client $950,000, but they're looking to retire, say, in the next 5 years. Well, we need to make sure that we've got the assets allocated in the right buckets, preparing them for retirement. So, we wouldn't want everything just in an index-based growth option. We might want to get a bit more customization. We don't want to sell down a portion. So we might need to use a wrap account to be much more individualized and personalized to the person's scenario. But when we're talking 10, 15, 20-year timeframes, these index-based options that are now available in industry funds and in in public offer funds, they also weren't available 10 years ago. So as much
even
as
5 years for that matter.
Even 5 years ago. So even though wrap accounts sometimes have a bad name and the fees, you know what? There's just so many more options at the moment. And I know Mazzy's the same. Like, we don't want to change someone's super fund if we don't need to.
Yeah. And so because there are legitimately crap super funds, I think, in terms of just their admin, their benefit payments for pension, for death, the performance is pretty doggy. Like, if someone came to you and they wanted advice for their super and they wanted to die on their hill of the fund that they've got, and it's actually rubbish, do you still go, well, we can recommend investments within that fund, but be warned? Like, how do you...
I have probably done this a couple of times. Maybe not so much they're tied to the fund, but maybe because the capital gains tax is too big to do it all in one lump. So it might be just, we'll make the best of what we can, or, there might be other reasons why you might want to keep that fund.
CGT is a big one.
Yeah.
CGT, we're working with a client at the moment. They had a massive CGT. We wanted to kind of transition that over a period of time. There was a massive capital gain on a few kind of holdings, and then there was some capital losses. So we kind of moved that out. And then we're going to kind of work over time in regards to building towards getting out of the fund. I actually had a funny one when you were saying this that I wanted to drop because we're talking ART. We recently recommended that a client move from UniSuper, I don't mind, UniSuper to Australian Retirement Trust.
But UniSuper isn't a bad fund.
Not at all.
In its
Not
own
at all.
right.
Not at
Yeah.
all. This was
All right,
but
I'll buy
it was a better option, okay, in this particular case. The client didn't go with the recommendation. You're going to hear this and maybe have a little bit of a giggle. They didn't like the Blue Monster.
Wow. Arty.
So I didn't pick that up on our profiling. We didn't pick it up on our fact finding that if you like the mascot of the fund.
Was that more of like a marketing thing? Like how much money are you spending on
No,
this
they
Blue
actually
Monster?
thought that the monster was weird to be the representative of a super fund and
Fair enough.
said that we need to revise the advice to remain with UniSuper. And that was good. Like we said, it wasn't a bad second option.
And like the
But-
reality is we can often do the strategies and get you to where you need to be pretty much with any fund. Product, it's always strategy structure first, product second. So if you really want to stay with a particular fund, like fortunately UniSuper's not a bad fund. But if it was really a dog fund or whatever you want to call it, yeah, we can like say, you know, you've chosen to stay in this fund, therefore this is the investment mix we recommend based on your risk tolerance and time frame.
And I think because we have the legal framework that we need to do advice that's in the client's best interest, because we're going through all of these, what we call 7 safe harbor steps to ensure that it's in the person's best interest, we can't say to a client like, oh, listen, we like the monster, therefore you should be an Australian Retirement Trust. That's not going to be justifying it in front of ASIC.
No, but a client can go, I don't like the colour and not doing it.
Exactly. So, and that's where like things, so we are going to look at things like fees. We're going to look like options. We're going to look at ease to work. What's their claims history been like? How do they all of these things justify the reason why we need to use it because we need to substantiate why it's in your best interest. Where when you don't go through that process, you might just not like the monster and you make the choice. So we're not making emotional decisions here. We're making logical decisions, trying to create the highest probability of you achieving, in this case, retirement when and how you want to.
Hey, it's Glenn here. Thank you so much for watching today's video. You made it to the end. Can I ask a favor? Can you hit that like button and maybe hit subscribe if you want to get notified when we release further videos just like this one, whether you watch the Money, Money, Money podcast or Retire Right. And remember, if you want to learn more about investing, I've got an investing book, The Quick Start Guide to Investing, and there's a link in the description to get your hands on a copy. Thank you so much. Bye.